Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment expert, Sam Bates. Now, Sam is a principal of Trinity Capital Group and owner of Paradigm Real Estate Investments. Sam's background is in financial services, state and local taxes, and real estate. He has been directly involved in the acquisition, rehabilitation, and management of over $200 million in multifamily and single-family assets since 2009. And so with that, guys, it's my honor to welcome my guest for today's show, Sam Bates. Sam, how you doing, my friend?
I'm doing great, Kevin. Thank you for having me on the show. I've heard your name in real estate for a long time, so excited to finally meet you.
Yeah, no, excited to have you here, my friend. And I know we were chatting a little bit before we started rolling here, and you got your fingers in a lot of different things. So I'm excited to kind of peel back the onion a little bit and just chat about all the exciting projects that you've recently completed, a bunch of exciting projects that are kind of in the works now. And so, but before we do that, Sam, I know that you've got a little bit more of an expansive background than what I did just a very brief overview of your background, your bio. And so maybe if you would take a few minutes and let our listeners know a little bit more about you and ultimately how you found your way into real estate.
Yeah, definitely. Really from an early age, I like numbers, and I remember in like first, second grade, multiplication, division, it just came naturally to me. And so I went and decided to get my undergrad in finance. And after that, I was planning on getting my master's in real estate. And in between the summers, I worked out at UBS as an investment analyst / intern. And they offered me a full-time job. And at that time, the stock market was going full speed ahead. Everything seemed perfect. So I decided it'd be a great experience. So I stayed out there mainly in equities and bonds, putting portfolios together for clients. Sometimes there was a lot of mutual funds. I decided to go back and get my master's. At that point, since I was in the financial services industry, I decided to get my master's in personal financial planning. And the university I went to also had a joint MBA program. So I just tacked that on. And while I was in school, the market crashed. I decided stocks probably weren't the best way to diversify and to invest. So I started working at a consulting company, didn't even think about really investments, but I was at several oil and gas consulting firms for 5 years and worked at a energy company for 5 to 6 years after that. And initially on in consulting, I realized I didn't want to spend 40 years doing that. It paid well. I learned a lot, but I worked all the time. Mm-hmm. And I started reading books about real estate. Luckily, I was in Dallas, so before meetup groups, there's just different real estate groups I've met quite often. So I started going there, and I jumped in as a limited partner on a multifamily deal. I was actually a limited partner on 3 deals, 2 multifamily deals and a hotel deal, and none of them blew the doors off. One did well, the other 2 didn't really do anything. So during that time, I was like, I should get in a single family. I felt like I had no control over the stock market. I felt like as a limited partner, I didn't have much control over the multifamily assets or the hotel assets. Like the hotel, we ended up in litigation. One of the multifamily deals, we kicked out the GP. So, wow. So there was a lot of things that transpired that didn't go right. And if they had have, I probably would have always been a limited partner. But I realized I needed to just start operating it. And at that time, I didn't have the capital or the time really to do a syndication. So that's what made me go into single family. And then after about 4 years, I realized you had to get into multifamily or other commercial assets to scale. And I started looking for multifamily. We couldn't really find anything. At that time, I was in my mid-20s, I think, maybe late 20s. So a lot of people didn't take us seriously, and they didn't think we could raise money. So after about 2 years of striking out, I decided to develop, and I brought in 2 people to help with that process, and it's just kind of went from there.
Okay. Well, I was going to take this in a different direction initially, but I want to back up a little bit. I want to dissect those first couple of LP deals if we could. And Yeah, I mean, so basically 2 out of 3 had some major challenges, and now that ultimately you bring LPs into deals, right? Like you're the GP on the GP side of things. I would love to, number one, know what what went wrong. Maybe we can just pick one of them. I think the multifamily one, you said you guys had to kick out the GP. Would love to know kind of how that all played out. What the challenges were, and then now that you're in that same position on the sponsor GP side, what do you guys do differently that ultimately you now realize it was so wrong and probably wouldn't have gotten involved with that investment if you'd have known what you know today?
Yeah. There was a lot of things that went wrong. And ironically, the operator I invested in is very successful. It was just, I think that specific deal he struggled with. And the main reasons he struggled was the first reason he brought on, or he started his own property management company at that time. And we're kind of like the guinea pig asset. And it was in Dallas, but we're in an area that was a lot worse than he anticipated. Like it's in a submarket that now the homes are $1 million homes. But there's pockets that were really bad. And he just didn't know how to manage the tenant base. That was one of the issues. So he self-managed. After he realized he couldn't do it, he fired himself, brought in a third party. He selected the wrong third party. And after we got rid of the third party, we kicked him out of the GP, brought in another third party. We had two of the LPs that had experience with multifamily. They kind of stepped in as a GP and helped ride the ship. And then with the market, I mean, this was back in 10 to 13. So the
market started actually riding the ship as well.
Yeah, the market also helped ride the ship. But I mean, it was a probably 27-month hold period, and we saw our first cash distribution probably month 24 or so. It was there was just a lot of things that went wrong. The on-site manager was stealing from us. There were some issues with insurance claim that didn't get resolved until after the sale. A lot of kind of the perfect storm just happened, and we bared the brunt of it.
Isn't that interesting? Because I feel like the market over the last decade has rising tide lifts all boats, right? Everyone knows that saying. And even if you've been a mediocre operator or sponsor, then you still look like a god, right? Like more than likely, even if you've made every mistake in the book, and if you're in just a half decent market, then you probably still look fairly brilliant. And but talking back to like you say, between 2010 2013. My guess is like the cost per unit on that asset is probably triple today what it was then.
And it's more than tripled. Like we bought it.
It'd be interesting to know if the rents have actually tripled in that same asset. Probably not. Probably not. Maybe doubled, but probably not tripled.
Yeah, I can't tell you what the rents are now and really even what they were back then, but we bought it for 17 a door.
Oh my!
We sold it for 31, I think, and now it's probably selling for 130, 140, somewhere in there. So definitely the market helped, but I think one of the things you said that I took from it was, even though he was in Dallas and he had invested in DFW, he didn't know that market. And
the submarket. It's such a, DFW is such a massive market. What is, I don't know, what's the population in Dallas Fort Worth?
I think it's 6 to 7 million right now. Yeah. I mean, they're projecting from September this year to September 22, another 174,000 jobs created. So it's just growing exponentially, and it kind of depends on what you determine, if it's like DFW proper, is it DFW MSA. So I mean, I've seen some numbers where it's up to 8 million in population.
Yeah. So it's interesting because there's still, even though we're in such a hot market right now, there's still, and most folks, if you're not in the DFW market, and we're not, and so I'm not overly familiar with it, but this applies to just about any market. Everyone knows that Dallas Fort Worth is hot with growth, and it's great, but that doesn't mean that every submarket is phenomenal. There's still challenging submarkets there. There's still challenging assets. There's still challenging parts of town. And I just, it's going to be interesting to see as time goes on, the years go on, if they're, when those assets that we're just talking about, and maybe that part of town has completely shifted, right? But there's still the challenging parts of town that probably are equally as challenging as what that one was back in 13, that are trading today for 100,000 plus a door, right? And so,
Yeah.
like you can beautify an asset. You can make all the improvements that you'd like. You can put the stainless steel in, you put the granite in, you can put the wood floors in, and LED lights, and do a beautification project or improvement on it. But you can't change the clientele of that particular neighborhood isn't shifting. You can't, unless you buy the entire neighborhood, right? Like, I mean, it's hard to attract quality folks if that entire neighborhood is still rough, or fairly rough around the edges. And so,
Right.
anyway, just time will tell. And again, rising tide lifts all boats as we sit right now. But when that tide starts rolling out, whenever it does, inevitably there will probably be some folks that are kind of caught with their pants down with less than desirable assets that probably paid, overpaid for them and over improved them, and never were able to attract that better tenant base that they had hoped for. So anyway, not to get off track here, I want to talk about your business model. You guys have your fingers in a lot of different pots. You do multifamily development. You buy existing multifamily. You do some single family subdivision developments, or some mixed use projects that you've done. So maybe give us a high level overview of the different types of projects you guys are in today, and really where most of your focus is heading.
Yeah, definitely. Like you said, we've kind of had our hands in a couple pots, and luckily I've surrounded myself with some great partners that one has significant more experience than I do. And he's had a construction company for 20 to 30 years now. And we've joined forces again, I guess you could say, where our plan is to do 250 single family homes next year. Some will be subdivisions, some will be more higher end build, custom homes, but a lot of them will be spec builds. Then we have the multifamily division, where we'll buy existing assets, or we'll do the horizontal and vertical construction, or we might even just do the horizontal construction. Like we have a land development right now. We have under contract for a REIT where we just did the horizontal. We're selling it to them. They're doing the vertical. We have 2 pieces of land right now under contract in the DFW area where we're going to start doing, we've already started the horizontal construction, then we'll go vertical next year. One will be student housing, and then one will be we aren't calling it a master plan community, but it's essentially going to be that, with a lot of single family homes, some duplexes, fourplexes, and then an apartment. So it's right on the path of progress southwest of Fort Worth, and we think it's going to do really well over time.
What's your long-term strategy with these different developments? I mean, are you not the single family? I'm guessing you're building spec homes and you're going to sell them, correct? Or are you going to?
Correct.
Okay, you're not doing like a build to rent model that's become
no
popular.
We might do a build to rent, but we just haven't done it at this point. I think build to rent's a very hot topic right now, and I feel like that's a buzzword, and it could be great, but if we do a build to rent, we're definitely going to sell it within 3 to 5 years. I think if you hold it 10, 15, 20 years, there's going to be a lot of maintenance costs that are significantly higher than an apartment, where a lot of investors aren't thinking that.
Yeah. As far as development projects, what's the long-term strategy? Is it build and hold? Is it build and sell? I mean, what have you typically done, and what do you plan to do in the future?
It honestly depends. Some of the projects I've done with my 2 partners, and they're more build and hold, long-term cash flow. But the syndications we've done, it's more so build, either refi and then hold for a few years and sell, or build and do a merchant build and sell. Like the student housing development we're in the process of doing right now is going to be build and sell. But we believe in this market. We believe in cash flowing assets long term. So ideally, we would like to hold forever, but doing syndications, the investors want their money back in a specific number of years. So usually we'll try to hold 5. Some syndications we've projected 10 years that are smaller. We've done a couple of joint ventures with 1 or 2 families that are going to be longer term holds, but they're fine with that. They have money right now to live, and they want to save for retirement or future generations and create that cash flow. long term.
What are some of the biggest challenges associated with scaling the development side of your business?
Right now, right now it's labor and materials. The supply chain issue really, even before COVID, when the tariff war started, because we import a lot of our materials from Asia. And when Trump and China started getting a tariff war, that hurt our business. And then with COVID, the supply chains killed it, and the labor. I mean, we've went through 5 or 6 pool vendors and can't get anybody to do a pool. I've talked to one pool vendor and he said he's booked from now until throughout 2023. So I would say almost the labor issue is probably the biggest issue on starting a development company, because you just can't count on contractors and subs. And we've always had subs, but we always want to get to a better rung or better quality sub, and doing that sometimes has been difficult.
So where are those better subs at present time? Do they just go to bigger projects that maybe have a longer project term, or what?
Yeah, I think they go to bigger projects. Like some of the projects we've done are 48 units or 60 units. Well, if they can get a 400 unit complex, they're going to do that before they do ours. So it's just the scalability. And even though a lot of people think a 60 unit project's large, when you're comparing it to a competitor or another person in the industry, it's small potatoes.
Yeah. How about, speaking of multifamily, I know that you've done both. You've both developed ground up, and then you've bought multiple different existing assets. And so, give me kind of pros and cons of each, and why you guys are really shifting more of your focus to buy or to developing versus buying existing.
I think the pros on buying existing is you have basically 60 days to close and you can own an asset. And right now, especially in where we are in the cycle of the market, most of the assets are cash flowing from day one, where you do a light value add, you bump rents. We bought a deal in Atlanta in January with increased rents literally over $400.
Wow.
Granted, it was under market. We've renovated more than 60% of the units at this point, but still, there's a lot of reasons why we're able to push it $400.
How have you been able to renovate 60% of the units in such a short period of time? Did they have a lot of vacancies when you took it over? Or did you just literally push people out because you knew there was such a significant rent premium that you'd be able to get with the renovated units?
Yeah, we've basically had to push people out, or we just raised the rent, and we've definitely changed the tenant base. We had always stayed above 90%. We haven't had to do a mass exodus. When we closed, we're above 90%. It's just been, luckily, I think timing has been perfect, where a lot of the leases expired and we're renovating about 7 units a month, maybe 6 units a month on average. So over the last almost 11, 12 months, yeah, it's worked out.
Yeah, that's fantastic. Wow, $400. That's huge. How large of a community is that?
It's only 134 units. I wish it was like 400, but it's just been phenomenal. Like, we've put in a lot of hard work, and our third-party manager's done a great job. But because every week we have calls and we're saying, how much can we push? How much can we push? And we just started trying $25 each week. And we started at $50 each week, and then it kind of slowed down. So then we started doing $25 each week. And we're probably blowing out year 4 or 5 projections now. And
yeah. What are some of the biggest bang for your buck amenities that you guys add to these when you're buying an existing product? What have you found to get the biggest ROI?
I think it depends on the market, but on this one specifically, this was built in the 70s. The exterior looked newer than the 70s, but the interior definitely looked rough. And it was literally across the street or across the lake from $700,000 to $800,000 homes. So we went in, put in kind of just your standard lipstick on a pig type renovations, vinyl plank flooring, changed out the appliances, redid the cabinets. We're averaging probably about $7,000 a turn. So it wasn't anything fancy or anything like stainless steel. Like in our deal in Orlando, we put stainless steel appliances in, and we're getting, well, on the 2 bedrooms now, we've raised rents probably close to $300, but on the 2 bedrooms, but on the 1 bedrooms, we've gotten about $150 rent pop. And we're going to be able to get another rent pop when we implement the smart package and smart technology. So, but I think just making each unit cohesive and adding new appliances or new kitchens or backsplash or whatever it is, it just makes the property look significantly nicer than what it was previously.
Mm-hmm. Got it. And so you gave some of the the pros of buying existing. How about any of the downsides, or then we can speak to development? Why you've chosen to go kind of both routes, and which would you prefer if you could get endless amounts of product in either or? Which would you prefer? Buying existing or developing new?
Well, just to continue on, I guess with the pros and cons is, as everybody that's in the space can buy multifamily, but they can't develop. So the competition to develop or to buy is significantly higher than competition to develop. So I think that's the largest downside. And you were talking about earlier, you might be buying in a less desirable area in a city, and you might be afraid you can't get the rent pumps or you can't change out the tenant base. I could say that even in like the urban core, if you're overpaying for an asset, if the market stays stagnant or drops, you might be in trouble. So I think with development, I like it because you have some cushion. It does take a long time, depending on the city, to get through planning and zoning. It took a couple years on one project to get just the approvals that we needed. There's a lot more headaches. I won't say there's more risk, but there's more uncertainties. The city's backed out. Well, one city in particular is backed out on something they guaranteed us, and we had to come up with extra 600,000. That you won't have to do that with acquisitions. So that we've been sued twice on developments. Both were erroneous and they got thrown out, but we had to spend time and energy and a little bit of money to fight them. So, but the developments, they do offer higher returns. The worst return we've provided on developments is around a 40% IRR at this point. And some, like our lot development, we 3x investor money in like 2.5 years. So the returns are significantly higher for us, but there's just more risk and uncertainty of things that could go wrong.
Yeah. So I'm going to switch gears a little bit here, and most conversations, not just here today, but most conversations, because we did talk actually about a few challenging deals, your very first LP deals. But most conversations that I have, revolve around all the, the 40% IRRs and the deals that went great, and just there's some headaches along the way. But talk to me about the one most challenging deal, the one that kept you up, late at night, the one that gave you additional gray hairs, right? Like the one that just stressed you to all ends. Give me some particulars on it. Maybe you have more than one, but pick one. I know you've been in it long enough where we've all had that one deal. What is it? What were the challenges, and ultimately how'd you overcome them?
Yeah, I think every deal has its own challenges. If somebody tells you that every deal goes perfect 100% to business plan, I would run. And I've been a GP now on 14 projects, and all of them have had challenges. And that's why we get paid, is to be able to learn how to pivot and go a different direction. But one I'll talk about was an acquisition we did, and we closed in September 19. And we third party all of our deals. And at that time, we brought in a third party manager I had experience with, I had familiarity with, and I thought it was going to be great. They've done really well on a project in another city. So I was like, okay, it's just going to be, because they're a large $1 billion asset under management type company, it's just going to be plug and play. And that's what they pitched to us. And it was the complete opposite. The two regionals that oversaw the two different properties corresponded with me completely different. They provided me different reports. The only thing that was cohesive was the financial packages we'd get on a monthly basis. But since I'd gained their trust at the other asset, I showed them probably a little too much latitude early on and thought that they could do the job. And it was in a military town where we did take it over at the most inopportune time, because we went under contract at 99% occupancy. By the time we closed, we were at like 91. And after we closed, they had 3 massive deployments the next 3 months, and we dropped down to 65% occupancy.
Oh, wow.
And I thought it was more so just the market and that environment and the deployment. It was the first deployment I've been a part of. And luckily I knew a couple other operators in the market, and they were like, well, we're at 80 or 85%. So I knew it was more so just on the management company. So I started going down there on a weekly basis, because I'm about 2.5 hours from the property. And even one week I stayed there the entire week and just looked at what the management company was doing. And I learned it wasn't much at all. And the on-site manager, from the moment I met her, I had a gut feeling that she shouldn't be there. And I trusted the regional, and I learned I need to go with my gut, and I needed to make a decision a lot faster. So after a couple months, we put them on a performance plan. They didn't improve. We fired them, brought in another manager, and it's been a great asset since then. And we're actually under contract to sell, and we'll more than double the investor return in 2 years and a quarter. But it was just, yeah, I think the biggest mistake I made was not acting as quickly and swiftly as I should have, and relied too much on their past performance and the company's performance, and not specifically on the regional and the on-site manager.
Yeah, got it. Good deal. And then, I know that we never put a property under contract with the intent on either walking away or retrading, what have you. But things pop up, things happen. During due diligence, you can discover things that weren't provided ahead of time, weren't disclosed. Has there ever been a point in time where you've actually spent some time and energy on due diligence and dug fairly deep, maybe, and spent some money, and ultimately decided to walk away? And if so, what were the reasons that you decided to pass on the deal?
We've never done that where we've got into DD and walked away from a deal. We are under contract on a deal right now that's been a thorn in my side. It was a complete off-market deal, and we had a relationship with a seller, and he came to us and he asked us if we would buy the deal, and we said yes. And then after we got through the process, we realized I commingled all his bank accounts with his personal accounts. He didn't have a rent roll. His financials, I still don't know if they're accurate or not.
Yeah.
He's self-made. Yeah. Complete mom and pop. He's managed it for 35 years. When you think of slumlord, he's the largest slumlord there is, but the assets are prime area Dallas. So it's like, we can't go wrong with the price we have him at. But we were supposed to close in September. We've had to extend it multiple times to get the lender comfortable, to make sure we have all the right contractors lined up, and made sure that we did our due diligence. So we've never had to back out of a deal, but on this one, we thought long and hard, and we had some hard conversations, and were able to negotiate with the seller. And we actually got a credit of about $750,000 because what he was telling us wasn't lining up with reality.
How large of an asset is this?
It's
mom and pop.
It's 3 properties, but the total portfolio is 110 units.
Okay.
And they're built, 2 were built in the 30s, 1 was built in the 70s.
Wow.
So there's a lot of deferred maintenance. There's like, we're putting in 40 to 45,000 per unit.
Wow.
In the doors.
Oh my gosh.
Yeah.
Are they in hip part of towns, like the old one, the 2 built in the 1930s? Are they in like really cool parts of town?
All 3 are close to each other, and they're probably about a mile to 2 miles east of downtown Dallas. and 2 are on what's called Swiss Street, and it's not right where the 2 property. Well, one of the properties is, but they're around. One of the properties is around these large colonials that, I mean, are $1 million homes.
Yeah.
One of the properties is right next to or catty corner from a property that went up last year, 2 years ago, that just sold for 255 a door, I think. And then the others on a main street that it's the eyesore, definitely, of the street. So we're in a great location. We got at a really good basis where we should be able to turn them around again. The young professionals, like literally some of the units are meth houses. But it'll be worth it when we can go in and
those are the deals that stories are made of. Yeah, no, it's good. It's good, man. It'll put some hair on your chest.
Yeah, it'll put some gray hair in my head too.
Yeah. Well, good deal. Well, anything else before we wrap this up here, Sam, as far as just any advice you'd give folks that are maybe just getting started, maybe looking to jump in, what have you? Just any words of wisdom you might be willing to share before we wrap it up.
Yeah, I mean, there's so much I could share, but since we've been kind of discussing issues or projects that don't go according to plan, like real estate's a forgiving business and everybody needs a place to live. So if you are investing in multifamily or single family, I don't believe it's a get rich quick scheme like a lot of the gurus will promote, but it can provide a great life. It can provide in flexibility or time where you might not have in a W-2, or I mean, it's given me the ability to give back to different causes that I think are wonderful and near and dear to my heart. So it's a great way to build wealth. You have control over it compared to a stock market or bond or even crypto. That gives me peace of mind and wants me to continue to invest and help grow other people's money and their portfolios to leave their legacy.
Yeah. Awesome, buddy. Well, I appreciate you coming on the show, Sam. It's been a lot of fun having you. Lots of great information, man. Wishing you all the best with both your current and future endeavors.
Well, thank you, Kevin. It was great to be on the show and great talking to you.
Alrighty, guys, that's all we have for this week's episode. So until we meet again next week, this is your host, Kevin Buff, wishing you huge success. Take care.